Welcome back into Mining Stock Daily, everybody, and happy Thursday afternoon. This week, Newcore Gold did publish that pre-feasibility study for the Enchi Gold project. That is not anything that was new or a surprise because we had been talking about this. They did promise to publish the report before the end of the month, end of the quarter, and here we are. Enchi's economics now sit at an after-tax NPV $647 million with an IRR of 45% using a $4,200 per ounce spot gold price. There's a number of CapEx changes in here based from that previous PEA, but Enchi's a different project now than that previous PEA was when it was published about 2 years ago. So happy to welcome CEO Luke Alexander once again. Luke, good afternoon. Good to have you back on.
Yeah, thanks for having me, Trevor.
Yeah, so let's just jump right into it. The stock, the market reaction to this, it was a rough day, down 24% on the day, while most of the sector was down. It was a rough day all around. So how much of that do you attribute to a weak gold tape versus the market maybe not, the PFS numbers around? And what was the disconnection here, do you think?
Yeah, so obviously yesterday when we put out the PEA, there was a real negative reaction in the market. As you highlighted, the gold sector was down anywhere, or the gold equities were down anywhere from 5 to 10+%. And there was some disappointment with the PFS that we put out. Some of the feedback that we got, and I take some responsibility for this, is that people hadn't properly appreciated the move from a heap leach project to a CIL project. At the end of the day, a CIL project is much more capital intensive from an upfront capital perspective, and then from a pure operating cost perspective, it's more expensive as well. I think a lot of investors overlooked the fact that we were moving to a CIL operation and didn't look at comparable projects in West Africa and around the world and what some of the costs associated with that were. So when we published this PFS out yesterday, I think certain part of the market had those heap leach numbers in their minds and ended up selling the stock on the back of that. Flip side is, for every seller there's a buyer, and obviously we had a lot of investors stepping in and seeing it as a tremendous buying opportunity. For me personally, when I kind of look at where we're trading today at roughly a US $75 million market cap relative to an NPV that we outlined in the project using a base case of $3,800 gold of just below $500 million, I think there's a real disconnect between the value of our project and where the market is pricing us today. So yes, certain investors were disappointed, but ultimately I think we've sold off to a level where there's a tremendous buying opportunity for investors who are looking at the project today. So when we look at, the numbers, again, $496 million after-tax NPV, 37% IRR, 1.6 year payback. Those are very strong, robust economics, and all of that compares to a market cap today of roughly US $75 million. So, from here, we've obviously got to get out there and highlight that real disconnect that there is between where we're trading and the true value of the project. One of the things that was encouraging, outside of obviously the pain of seeing our stock down meaningfully, and us as management and board, we own 12% of the company, so we felt the pain alongside our shareholders, was we did have a number of very encouraging emails and phone calls and comments from, industry peers and some of our very technically focused investors, analysts, and invested bankers who said, yeah, this really sets the floor and a foundation for us to ultimately build off of. If you look at CIL projects, that's ultimately what the typical way of processing ore in West Africa and around the world is. So highlighting this as a CIL project and something and a project that's very defendable in terms of the inputs that we used. We received a lot of very positive feedback from our peers and a number of industry, focused individuals. So that was encouraging. It
Hmm.
didn't offset the pain of a 24% down move, but at least it softened it ever so slightly.
Well, I felt the down move myself as a shareholder as well. But even if you just take the economics with what it is from the PFS, they're still positive, right? Now, are they? That's definitely not what was in the PEA. But I think that in hindsight, and hindsight could be a fairly good thing because I've had now a day and a half to read some analyst notes and whatnot and get some feedback on the PFS as well. And from what I'm reading from, people covering the story here is that they're uniformly telling clients not to compare the PFS to the PEA, although they have to write the comparisons in, what those numbers were and what they are. But, in your mind, is the CIL, the cost of the CIL, really the single most important thing people are getting wrong about this story? Or I mean, maybe not just wrong, just maybe missed.
Yeah, so I would encourage anyone who's listening to this, if you do have access to Haywood, SCP, or Canaccord's research, to go and look at some of the comments that were published yesterday. They obviously all cover us from a research perspective. They went in detail and looked at this at this PFS and came up with notes on the back of that. So I would encourage you to go have a look at that. It sounds like, Trevor, you've read some of that
Hmm.
research. I mean, when you look at, again, a CIL project, that is the standard way of processing ore in Ghana and in West Africa. One of the real big opportunities for us is, if you look at this PFS and you look at the first 3 years of production, we process roughly zero point 0.8 gram per ton material. That has a meaningful impact from a production perspective. We average 130,000 ounces in those first 3 years. Our all-in sustaining cost drops by about $300 as a result of processing that higher grade material in those first few years. Obviously, the free cash flow goes up meaningfully in those first 3 years. So one of the big opportunities, and I would encourage you to go flip through our presentation and read our press release in detail if you haven't, is with this current 80,000 meter drill program, is to go and add additional higher grade material to displace some of the lower grade material that starts to come into the mine plan in years 4, 5, and 6. If you look at our current 80,000 meter drill program, the first 28,000 meters was focused on infill. So purely moving ounces from the inferred to the indicated category, which is a key requirement to ultimately then be able to produce a PFS. So that was the first 28,000. We used a cutoff date of October for that drilling. So all of the drilling that we've done and released since October, which is roughly 12,000 meters, none of that is included in this PFS. We then have an additional 40,000 meters of drill results that will come into future resource updates and future studies. Our goal
Hmm.
with that drilling, and we're seeing it with some of the results that we've been putting out over the last number of months, is to bring in some additional higher grade material, which then will displace some of that lower grade material, again, that we're seeing come into the mine plan in years 4, 5, and 6. That will and can have a meaningful impact on the MPV, the economics, and the overall study. So that's one of the big opportunities for us, and something that we're very excited with the 4 rigs that are turning on site at the moment.
Okay. One of the other things that kind of creeped in to the cost factor is the new sliding scale royalty from Ghana. Sliding scale, there's a wide range that's just based on the gold price, but currently $3,800 per ounce sits at 10%. That wasn't in that PEA back in 2024. So maybe help us understand how that's kind of built into the PFS here. Is there if gold has another run past $5,000-$6,000 here, Luke, let's think of something positive. If gold makes another run, does that sliding scale increase for Enchi?
Yeah. So I guess first of all, let's kind of highlight your $5,000 case. And again, you can pull up the sensitivities in our presentation, and on slide 13, you can see the sensitivity to gold price on there. At a $5,000 gold price, we're looking at an after-tax NPV of $960 million, 58% IRR, just over a 1-year payback. So there's a tremendous amount of leverage to the gold price. When we started putting a pin in on going forward with a CIL PFS, gold was trading around $5,000. If you look at the average gold price for 2026, it's roughly $4,700 or $4,800. I mean, the economics dramatically improve and change with higher gold price, and that is one of the advantages of a lower grade resource. Is there's a tremendous amount of leverage to the gold price. So if you're a believer in gold, then that's a great opportunity. Specifically on your royalty question, our 2024 PEA included a 5% government royalty. Since then, they have moved it to a sliding scale royalty. It caps out at 12% at $4,500 or higher. So in your $5,000 gold price scenario, it would be a 12% royalty. At $5,500 gold, it would still be a 12% royalty. Between 4,000 and 4,500, it's an 11% royalty. Between 3,500 and 4,000, it's a 10% royalty. So it drops by 1% for every $500 move in the gold price. And then, as I said, caps out at 4,500. So within this PFS, it does incorporate on our base case of $3,800 gold, it incorporates a 10% royalty, which is what we would pay at that gold price. But I do like your $5,000 scenario, and you like how I now call it your scenario, because obviously, yes, we would pay a higher royalty, but the NPV of the project does rise to almost $1 billion. That compares to us today sitting at a US $75 million valuation. So tremendous leverage to the gold price.
Yeah. Okay. Let's talk about kind of the importance of the exploration program now with this PFS out. Obviously, you've included the CIL CapEx and OpEx, yet the resource that you have in the PFS doesn't feed that. However, we've reported a lot of drilling deeper that would feed that eventually with the new resource estimate out there. So, and I know it's only been about 36 hours here, Luke, but how important is the next, 30, 40,000 meters of drilling to really better define the sulfide, the fresh rock material at depth, to help really kind of find some equilibrium with the CIL CapEx?
Yeah, so one of the things that we identified through the whole kind of trade-off process of looking at heap leach only, heap leach plus CIL, and then CIL only, and ultimately deciding to go with the CIL for the PFS and ultimately using that from a processing perspective going forward, is it gives us a lot more flexibility from a pure processing perspective. So if you look at the mine plan that we've got within our PFS, we ultimately go and mine the oxides straight into the transition, straight into the fresh material, and that creates a lot of benefits for us. So at our Boyne deposit, which is where we focus our initial production, if and when we find additional ounces there, and if you go look at some of the cross sections within our presentation, you'll see 3.5 grams over 23 meters, 8 grams over, 7 grams over 8 meters, 1.7 over 25 meters, 3.2 over 17. You'll see a bunch of this well above average grade material that we've intercepted immediately below the pits at Boyne, as well as if you move over to our largest deposit, the CIL deposit, we've continued to intercept above average grades just below the pits. So if we can continue to do that and continue to string those intercepts together, what we would expect is that we'll be able to ultimately deepen and widen our pits and add that 8.8 gram plus material to years 4, 5, and 6, which then obviously helps contribute to the overall economics of the project. So any exploration success that we have is going to complement and bolster the PFS that we put out yesterday. So that's really a big part of the focus, is continuing to find this high grade material sitting immediately below or beside the pits that we can then move straight into a future mine plan. And with the drilling that we've been doing, we're feeling confident that we've started to identify some of that material.
Okay. Have you done a whole lot of metallurgical test work on the deeper fresh rock and how that kind of fits into the CIL?
Yeah, so you'll see it in the presentation, but then once we get our full 400 or 500 page technical report out in the next 45 days, you'll see a whole detailed section in there on metallurgy. But in 2025, we spent a lot of time doing additional PFS level met work, looking at columns, bottle rolls, looking at the oxide material, the free dig transition material, the harder transition material, as well as the fresh material. And that was one of the key drivers to us transitioning to a CIL. The recoveries that we were seeing, and within this study, you'll see we've got an average of 90.5% gold recovery. That was one of the key aspects. Is with a CIL plant, you obviously recover a lot more gold. And as we discover more fresh material, we're going to want to obviously put it through a CIL mill to make sure that we're maximizing recoveries from that perspective. So, yes, a lot of work went into that in 2025. And we've now kicked off the process of starting some of the feasibility level network, which will then feed into future studies.
Okay. Uh, with this PFS, you showed a 9.3-year mine life, I believe is what I saw. But I'm obviously with the tremendous amount of drilling, it'd be pretty easy to see an extension of that mine life almost right away. If you're not already pricing that in, some of us who have been living this project for a number of years now, maybe walk us through what your modeling looks like. How, is it be pretty easy to find another 3, 4, 5 years of mine life onto this and perhaps already been drilled out?
Yeah, so couple things on that front. One is we've talked a lot about the ability to add ounces immediately below, beside, and along strike from the existing pits. So as we discover that material and move it from inferred to indicated, then that could contribute from a mine life perspective. But again, more importantly, we want to displace some of the lower grade material in years 4, 5, and 6, because that the closer you have that grade to the front end of your mine plan, the more impact it has from a NPV economics perspective. So that is a big focus, is finding some of that higher grade material. What we haven't talked about is we also have 600,000 ounces still sitting within the inferred category.
Mhm.
Within that 600,000, we have identified some ounces within that make sense to convert immediately, and obviously that would also add to the overall life of the mine that we've got today.
Okay. Let's talk about what happens next here, Luke. A lot of time to kind of think and see the market response, but also there's still a timeline here for entry. We'll continue to move forward and development happens. Drilling is continuing, a lot of test work, optimization work, all those things. So it's not, the work never stops. So maybe walk us through what does the next 6 months, the rest of 2026 look like here for entry and what's kind of on the table for you and the team?
Well, one of the things we, from a corporate perspective, need to get get out there and highlight the disconnect that we're seeing at the moment between where the market's valuing our project and the actual fundamental value that we've outlined within this PFS. Again, broken record, but we're trading at a $75 million US market cap today relative to an NPV of almost $500 million at $3,800 gold. And using your scenario, $5,000, we're looking at just under $1 billion after tax NPV. So you look at where we're trading relative to the value that we've outlined, and I think it's a complete disconnect. Beyond that, we've obviously got an additional 40,000 meters of drill results that are going to come over the next few months. We've got 4 drill rigs turning at the moment, 3 diamond, 1 RC. So we will continue to get lots of drill results out to the market. We'll be looking to add that additional higher grade material that will have immediate impact on future mine plans, as well as the resource. And then beyond that, we've already kicked off a bunch of feasibility level work, which we're doing in the background: geotech work, hydrological work, met work, environmental work. All of that is being done at a feasibility level, which will then go into future study. The other thing we're going to do is apply for a mining lease. One of the key things you need to be able to apply for a mining lease in Ghana is to have reserves. With the publishing of this PFS, we have the first ever reserves on the project. So we'll now be able to use the PFS, which includes those reserves, and apply for a mining lease. We've got a lot of support from the government. They want to see us get this project into production as quickly as possible. They recognize the benefit it will have for the Enchi region as well as for the country as a whole. So we'll apply for that mining lease in Q3, so in the next three months or so, and we would look to have that in place in 2027. We see that as well as a major de-risking event to be able to have a mining lease in place to drive this project forward. So those will be some of the key things to look out for over the next few months.
No. If I had a 10% royalty on Enchi, I'd want you to put that in production as quickly as possible as well, Luke.
Yeah, and it's obviously it's a double-edged sword. I mean, as you say, yeah,
Right.
10% royalty, it's costly. But on the flip side, you've got a government that's very motivated to see projects go into production. When you look at Ghana as a whole, we're one of the 2 most advanced projects in the entire country from a development perspective. So there's a real recognition that, there's a lot of benefit to come from getting Enchi into production. And with the support from the government, that's something we'll look to do.
Yeah. Okay. So the implied path, as you mentioned, mining lease application in just a few months' time, potentially construction decision sometime 2027, couple
Well,
years build out.
PFS, we've just published. We would then look to go to a full feasibility study
Okay.
in the second half of next year, and then look at FID and construction decisions in 2028, and potentially break ground in 2028 as well.
Okay. So let's finish with this, Luke. I mean, what de-risks this runway, uh, and what could maybe compress it over the next 18 months?
So I think this PFS, despite the initial knee-jerk reaction in the market, is a meaningful de-risking event and milestone. I mean, there's a very good project here that outlines very strong, robust economics. Sure, maybe it came in below what some were expecting, but again, a PFS is a major de-risking event for any company, and for us, it's a major de-risking event for our Enchi project. We now have an opportunity to build on this by continuing to aggressively explore on our project, look to add some of those higher grade ounces that we talked about that will then improve on the economics that we've already outlined within this PFS. Obviously, under your $5,000 scenario, you start to look at the economics, and they're tremendous for this project. So, if you're a believer in gold, as we are, hence the reason we're in the gold business, we see a lot of upside from here, but we need to get out there and obviously highlight that upside and the reason why that initial knee-jerk reaction was unwarranted. So,
Yeah.
so that's something we're focused on in the near term. We've talked about the exploration upside. We've talked about the impact that can have from a displacement of ounces perspective. So that's something we'll continue to focus in on. Getting a mining lease in place, that's a critical de-risking event for the for the company and for the project. And then all of that additional feasibility test work that we're doing in the background is something that it may not be as headline newsworthy, but it's a
Right.
critical aspect as well for us to complete, and that's already started.
All right. I'm going to finish this. I got one more question, but before I lean into the question, I am going to editorialize a little bit, just as from a shareholder perspective, if I may. But I think the moment Newcore transitioned to a CIL flow sheet, it was setting up the project for an acquirer and doing what's available and what a lot of other companies, most other companies are doing along the same belt and how it's operating. And so you really teed it up for something that maybe was eventually going to be on the selling block. Because if it was a project that you ultimately were just going to do yourselves see through and not be for sale, then you know it maybe make more sense to stick with the heap leach scenario because because of the costs are a lot lower, and that's something you could do. But because of the CIL and the way you framed this project now with this PFS and shown the numbers, I guess the question I'm leading, does this enhance or does this flow sheet enhance or change who that buyer is potentially? Do you potentially have more options who comes in who'd be more capable, more interested in the CIL operation and just kind of turnkey, let's get in there, take over Enchi and do our thing, compared to having to piecemeal the CIL afterwards on top of a heap leach operation? I know that's a long editorial and question, but does that make sense?
Yeah, no, it makes complete sense. And I mean, Trevor, we've kind of chatted about it before. I mean, when you kind of look at M&A from a whole, you ultimately or broadly look at M&A. If you're looking at a project, you want a project that's attractive to the most potential acquirers as possible.
Mm,
A heap leach project is a very bespoke type project that not a lot of operating companies are involved in. And specifically in West Africa, there's a very limited number of heap leach operations out there. So, purely from a heap leach perspective, by having a PEA that outlined a heap leach project, it was a very bespoke project that would only be of interest to a select group of companies, let's say.
mhm,
And a lot of our discussions would start and end once we talked about heap leach. When you then look at a CIL project, it is a much more conventional project that obviously within West Africa is the standard way of producing gold. And around the world, it's the standard way of producing gold. So you've opened up the potential network of acquirers significantly by having a CIL operation or outlining a CIL project. One of the things we've also talked about in the past, if you just want to talk about M&A in general, as you de-risk a project from PEA to PFS to FS, along that path, you will see increased interest from an acquirer perspective. The same reason why the market should pay a higher multiple for a project that's at a PFS or an FS stage or in production, um, is the same reason why a potential corporate acquirer is going to be more interested and ultimately pay a premium for those projects, is because of all of the de-risking work that happens along that path. So, PEA metallurgy versus PFS versus full feasibility metallurgy is significantly different. A lot of additional work needs to go into being able to get the QPs to sign off at a feasibility level from a metallurgy perspective. Same goes for environment, baseline, geotech, hydrological, resource. The reason you can only use indicated ounces within a PFS and FS is because the drill spacing's a lot tighter and there's a lot more confidence that those ounces actually exist and sit there. So for all of those de-risking reasons that I'm highlighting here, plus a number of others, the group of investors, but in this specific discussion, the group of corporates that are going to be interested in a project like Enchi or another PFS, FS stage project, is because of all that de-risking work that's happened. It provides the ability for them to come in and basically take the project and put it into production as quickly as possible. One of the other key aspects is having your permits in place. You'll often see companies will just, M&A will happen immediately on the back of licenses being granted. Again, all of those hard yards, that works happened to allow a producer or mine builder to ultimately come in and put a project into production immediately. If we look at some of the M&A that we've seen in Africa, in Ghana specifically, you look at the Namdini project. Shandong came in and bought that project in a full-on bidding war with Nordgold. They then were able to optimize it, put it into production within 3 years of buying it, and are now on track to producing 325,000 ounces from that up in northern Ghana. Osino in Namibia, same thing. They took it to a PFS, FS stage, and ultimately, there was a bidding war for that asset. OreCorp, same thing in a bidding war for that asset. So the trend is that as you take these projects along the development curve, then M&A typically or interest from an M&A perspective increases meaningfully, which is also the reason why the stock should trade higher through that de-risking phase as well. So I know it's a bit of a longer-winded answer, but I wanted to match your long-winded editorial with just as long-winded an answer.
Well done and touche. All right. Well, let's leave it at that. We're going to be talking more as the year progresses, a lot more drill results coming out of Enchi. And so more conversations along the way. Newcore does trade on the venture with NCAU and on the OTCQX with NCAUF. Luke, good to see you once again, and we'll talk to you probably in the next few weeks.
Thanks a lot, Trevor.
The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.